Hi everyone, welcome back to my channel. So today's video is all about how to invest your first $1,000 in the market. Now I wanted to make this video real quick just to kind of go over the information for anyone who's new. I get a ton of questions with people asking how they should spend the first like $1,000, $2,000 that they have to invest. And oftentimes I know it can be a little bit intimidating, so I definitely wanted to make this video to hopefully ease the minds of those who are just starting. So I'm going to jump right into it. Y'all can clearly see here on the screen, I already have the investment allocation pulled up. I'm also going to jump into Thinkorswim in just a bit as well. But I first wanted to introduce this so that you can see a full breakdown. Now, in my opinion, it's super important to categorize your investments. That way you allow for a diversified portfolio to be developed. Now, with that in mind, I do like to have mine divided into 5 different categories. First being the long-term buy and hold. And these are going to be tried and true companies that are trusted. So I would recommend about 30% of the $1,000 go to those types of companies because this keeps the growth concentrated but not reckless. Next up is going to be the core ETFs. I would recommend about 30% of the money is allocated here simply because ETFs reduce the drawdown severity and it also helps smooth out the equity curves, and this is necessary with small accounts. Now next I would say is the short-term holds. It could be about anywhere from 15 to 20%. And you can use this as your swing capital. And then when we take a look at the leaps, I would say about 10 to 15% because this can be your controlled leverage. Last but not least, I would say your options. These are going to be your short-dated contracts. This is going to be strictly controlled. But again, options are going to be the most risky out of all 5 categories. And that's simply due to the volatility of the stock market. Now, the really good thing about breaking it down into these categories is that it will help you avoid overexposure to decay. It also can help eliminate the excess concentration into one specific stock or one company because the risk is obviously much higher if you're all in on only one. Now, granted, if you wanted to be more aggressive, you can definitely have stocks at like 40%, ETFs at 25%, maybe the leaps at 20%, and then combine like short-term and options at 10 to 15%. But if you're one to be more conservative, you may look at this and say, hey, this is too risky. So you may want to drop down the investment in stocks at maybe 25%, the ETFs at 50%, the leaps at 10%, and then combine the short-term and options at 10 to 15% as well. Totally your choice on how you choose to strategize. But let's go ahead and hop into TOS so I can show y'all a few of the stocks and ETFs that I would prefer to have on this list. Okay, so definitely want to start it off with some ETFs. One, because they're the safer investment as mentioned, and it's all about capital preservation. So when we take a look here, y'all can see I have Charles Schwab ETF pulled up. Ticker symbol is SCHD. And this, of course, is going to be the equity ETF. Now, this is diversified because it is a dividend grower with a historically solid yield at about 3.3%. So if you ever wanted to take a look at their balance sheets and their profitability, I'm pretty sure you'll be pretty satisfied with what you'll see. The numbers do favor the growth of this ETF, and this fund does invest in dividend-paying stocks. You'll also notice that the share price is pretty affordable as well at $31.48, at least at the time of filming this video. So historically, there's also lower drawdowns occurring during volatility within this ETF, and that's another added benefit as well. So you really get the opportunity to stabilize your performance while compounding income with this ETF. So that's one of the reasons that I really like it, and it is on this list. Now, another option that you may have interest in if you're looking to invest is going to be JP. Now, this is going to be JP Morgan's equity income ETF. Now, this is a large cap ETF using option premiums, of course. Now, one of the really beneficial aspects of this ETF that separates it from others is that the dividend yield is at 8% annually, and that's obviously attributed to the premium strategies. The share price is also affordable at $59.51, and it helps you maintain the growth exposure as well. Now, if you couple that with the calculated leverage for long-dated options, you definitely can be in the game with this one. All that to say is that you can avoid complexity that caps upside early. So that's why I generally like ETFs as a best investment. Now, staying along the lines of JP Morgan, you can also choose to do JEPQ. This is another option. But in this case, it's the NASDAQ-focused version of JEPI. Now, the dividend yield for this one is about 10%. Because there's higher technology exposure within this ETF. Share price is at $58.67 currently, so you're definitely going to see a high ROI. Obviously, over the last 5 years, you can see here from this line graph how this ETF has grown. So definitely take some time and do your research to see if these are ones that you would want to fit into your portfolio. Now, by default, we all know that SPY and of course QQQ are good options as well. But I will say SPY's share price is at $693.15. So it's not always the most affordable option for those who are brand new. Same thing with QQQ. If we pull that up, we can see that the share price is $616. So again, obviously not the most affordable, but a trusted and reliable ETF if you did want to invest. Now, the really good thing about QQQ is that it has a higher earnings growth profile because it's definitely a heavyweight when we look at AI, cloud, and like semiconductors. Historically, the volatility is high, so keep that in mind. It does offer a higher upside potential with that as well. And this just obviously increases the expected long-term return relative to the broad market alone. So again, if you're trying to stabilize your portfolio without sacrificing the capital, be very, very selective. Now, keeping along those lines, if we take a look at XLK, for example, this is going to be an ETF within the technology sector, but it's much more affordable. You can see the share price at $143.14. They also list the top 20 holdings within this ETF, so you get the opportunity for the exposure for all these companies. And I will say, most of these here are going to be some of the strongest earning drivers in the market. So this ETF would have a higher beta than like Schwab's ETF, for example. And this is useful for when you're compounding during expansion cycles. So definitely one of the choices to keep your eye on if you ask me. Now transitioning over to some of the stocks, I am going to pull up one that's in the growth sector, and that's going to be Palantir. Now this definitely has been a company within the last 3 to 5 years with so much talk around it. There's a lot of speculation on the highs and the lows, but clearly we can see the growth within the company. But with Palantir, the essential thing to keep in mind is that if you want direct AI exposure beyond mega cap tech, this allows you to invest and do so. So if you can tolerate anywhere from like 25 to 40% drawdowns just simply because of the fact that this is going to be a riskier investment, then I would always recommend investing when you do see that drawdown. But you also have to keep in mind that you should be willing to hold through volatility cycles, because with this, you're not relying on any dividend income. So to be honest, if you're risk adverse or you need stable returns, Palantir may not be the best option for you. And that's attributed to the fact that the valuation pricing still reflects the anticipated future probability much more than current earnings. It is affordable though, because we can see the share price is at $134.78. And they do have it anticipated within the next 3 to 5 years to outperform many of its competitors. But the fair warning on this is in tightening liquidity cycles or valuation compressions, it can underperform very, very quickly. So again, you kind of weigh the pros and cons with this one. Okay, so now when we transition over to taking a look at leaps, let's go ahead and take a look at Shop. Now, y'all have heard me talk about Shopify several times before because this is one of my favorite stocks to trade for the seasonality purposes. Oftentimes people sleep on this stock, but to be honest, the ROI is extremely high if you invest at the right time. Now, in my opinion, this is going to be the definition of what I was saying earlier, which is your controlled leverage. With these types of companies, you're not exposed to such a higher risk if you can trade your leaps appropriately. So I always like to set mine anywhere from like 12 to 18 months out, and I'm typically looking for in the money or deep in the money. And the reason being is because of capital efficiency, and then also I love the upside participation with limited defined capital at risk, because again, the share price is only $121.54. So the time horizon for me, this always reduces the decay pressure. And just to kind of highlight this for precision, when you are trading this specific stock with options, if $100 does not secure a quality deep in the money contract, definitely increase the allocation slightly or delay entry until a major pullback. That way when you take profits, you're maximizing your gains. And truthfully, there's really no capped upside with this, so that's another reason to add to it. Okay, y'all, so one more that I do think is one that's often slept on is going to be SKT. Y'all have heard me talk about this before. Now, this is actually going to be a REIT. And if you don't know what a REIT is, it's simply going to be a real estate investment trust. And it's one of my favorites on the list. Y'all see the share price is here at $37.61. And you can also look at the growth over the last 5 years as well. And this doesn't necessarily say a whole lot because the share price isn't very high. But still, growth is growth. So definitely want to keep on the list and do some research on yourself based upon what you feel is best. So yeah, y'all, these are some of the best ETFs and stocks I feel are going to be worth the investment, especially if you're starting with a small account. So feel free to let me know your thoughts by leaving a comment down below, and that'll just about do it for this video. I thank y'all so much for watching, and of course, I'll see y'all in my next one.